Now I want to talk about strategies for real estate. Now, real estate is very important. Um, in America, if you want to build a wealth, you want to do three things. One is real estate ownership. Two is business development. Three is tax deductions. So real estate actually combines almost all the three uh, strategies together. So so first, let's just look at the content of tax law as we talked. Um, so real estate really is an income, right? You're coming from the income section where you could be just rental income, or you could be an S corp, dividend income like that. Okay, and then so we talk about three tax strategies. One is earn as much non-taxable income as possible. So here for real estate, for example, one is the primary resident sales exemption, capital gain exemption, up to $500,000 for a married couple. And for single, it's $250,000. You want to take that strategy as a first step. And then when you invest, you make sure you use rules like 1031 exchange, which I will talk later. So make the most of adjustments to income, deductions, credit. That's the second tax strategy. Tax credits for real estate are a lot, such as low-income housing investment credit, disabled access credit, enterprise zone, rehab credit. And then you can shift the income to other taxpayers and other tax years through, for example, depreciation, 1031 exchange, gain deferral, installment sale, sales and leaseback, and some global strategies. So first, let's look at the 1031 exchange. So let's say you have $500,000 capital gain, and with that, within that, there's $200,000 as a depreciation recap. Why you have to do a depreciation recap? Because when you do the tax return over the years, you have every year you have the depreciation as expense, right? So now you have to recap, and so the depreciation recap is taxed at 25%. Others may be taxed by the 15% or 20%, depends on your tax credit, right? So here, let's, for example, suppose your federal tax is 15%, times $300,000, $45,000. State tax is 9.3%, $46,000. And so you add all the capital gain tax owed is $141,500. Okay. Now, if you do a 1031 exchange, no tax hold. So without the exchange, you have $358,000 left to invest. Okay. Now, with that invest, you probably get $10,000 annual income, $800 monthly income. Now, with this fully invested, if you roll over to another real estate, you're likely to get $40,000 annual income. You have $3,000 monthly income, right? So it's 4 times more income. So you think about that. This is big. So you really, really want to take advantage of 1031 exchange if you are investing in real estate. So the 1031 exchange is like that. In the first 45 days, you have to identify your property, and then within 180 days, you have to close escrow. Now that is very difficult, especially in places like California. You want to find one that's cash flow, like during this kind of time. It's very difficult. So the innovation comes with a DST. So DST is called a Delaware Statutory Trust, and it works like a tenant in common or like private REITs. So the benefit is you can unlock the power of equity, and there's a professional team looking for qualified properties ongoingly. So whenever you go there, there's always a pipeline of properties already ready. qualified investment grade properties ready, and non-recourse financing pre-placed with lenders. So you also get the leverage. And the good thing is it's non-recourse, because DST is a trust. So the trust is borrowing, not you are borrowing. So aggregated power for better low risk, larger properties. Now with more people, more investors together, instead of buying one single family house, now you can buy an apartment building. You can buy an office building in downtown Los Angeles. You can buy a data center for AT&T like that. So worry-free management of properties. Usually these are triple net lease leases and managed by professionals. So you just stay home and collect money. So this is how DST works. Usually there's a sponsor, and you want to make sure it's a credible sponsor. That's important. You choose that. Okay. So these are the steps of DST. Now, DST is not like you buy your property by yourself. You can sell it anytime you want. DST now is a group of investors. So a group of investors, usually you have to be ready that this is for the interest of group. You can't just sell it. And for the interest group, usually the trust will hold the property until it's profitable. Now, if you look at the real estate cycle, usually takes 10 years, right? So you could be waiting for 10 years. So just be ready with that as a timing issue. Oh, another way is installment sale. Installment sale, basically you spread out the gain over the years, so that you do not pay capital gain tax in 1 year. You pay it gradually. And then if you do other strategies, you reduce your overall income, you may not pay capital gain tax or reduced capital gain tax. And if you, with an installment sale, you still want the whole money, you can actually have a loan and get the whole money. And then the installment contract becomes the collateral for the loan. Of course, you usually pay a little bit of fee for that. Now you can also do an installment sale to your family, say to your children or to your parents. This way you defer the gain and you save tax, and children can live there and deduct interest. And if children rent the property out, they can take depreciation and have nice rental loss deduction for their tax. Or you can lease back after sale to your children. They can still take depreciation, that's rental loss, and you still live in your home. If you have a home-based business, deduct a portion of the rent as office rent expense. You do not need to worry about estate tax anymore. You already sell to your children. Right? So these are strategies, or you can just give to your home to your child and lease back. At least now they can harvest the depreciation that was not used. If it is leased back to you as your business place, you created a rental deduction and reduced your business income. You can buy your parents' home if their homes are paid off. There's no interest deduction anymore. And now you can take the interest deduction. You can rent back to them and take rental loss. Chances are they already qualify for the primary home loan exemption of $500,000. Then there's no need for installment payment for them. You can combine business with real estate strategies. You can have a separate LLC to own property and lease it to a business, say your S Corp. So this way you reduce income, payroll tax, and the social security tax and income tax for your S Corp, and then shift the business income to the leasing entity. And the leasing entity with depreciation, loan interest, you may have rental loss. You can sell or gift interest in the property without diluting your business ownership, or vice versa. Create a retirement plan using one of the entities, and then you refinance property to take a tax-free cash via loan, and also a good asset protection strategy. Closely held insurance company, that's a very interesting strategy that really it's for business, okay? But if you have a rental business and you have a large income, real estate income, you can also use that. But really this is great for business. So you can deduct premium from your business, and we call CHIC, CHIC, can avoid tax on premium income up to 1.2 million annually. And CHIC capital gain is taxable. Yes, it's still taxable. But if you think about investing in alternative fund or uses QSBS that we talked before, you can still be capital tax gain free. And change income, so this basically change income from ordinary income to capital income to capital gain. So reduce your earned income by taking foreign earned income exclusion over $120,000 plus housing exclusion. So most of the time, closely held insurance companies are set up in an offshore place. And then you can, if you work there, you get the foreign earned income exclusion. You can also use your IRA to buy real estate, have the real estate have tax-free growth. And then you can also buy insurance or annuity to fund your retirement after that. And you can never pay capital gain. Pass on to your children without probation. Okay, and then the death benefit pass on to your children, no income tax for them, no estate tax. Okay, when if you use it for by insurance. So set your family trust as your IRA beneficiary. They do not need to sell the property after you die. Use tax-free money to buy real estate if using traditional IRA. Syndicate everyone in the family to leverage the power to purchase property if your fund is not enough. Or just buy fractional interest of a property. For example, you invest in DST or pre-IPO REITs. Beware of prohibited transactions. Have a lawyer prepare the trust. So here I also want to say the donor advised fund is really good. It's a much simpler alternative to starting your own family foundation. You can still name it as a foundation, but this one is just like a IRA you can open in a bank or a community foundation. And you can put the money in there and you get tax write-off right away. However, you don't not have to distribute it to a charity immediately. You can give it to them anytime you want. And if you don't give them fully after you pass away, this will continue to pass on and your children can be the trustee. So you create a legacy. This charitable remainder trust is very important. Say if you have an appreciated asset, whether it's real estate or stocks, you contributed to the trust, and then the trust sell it. It does not have to. The trust does not pay any capital gain tax, and then it invests into some income producing vehicle like bond or stocks, and then you can receive the income. And then when you pass away, it passes to the church. Pass to the charity. This way you unlock your equity. The key here is you unlock the power of your equity. Now you receive more income. Okay, if you have a real estate, you bought it for $1 million and you're receiving rent of say $10,000 a month. Now the house worth $2 million. If you don't do anything, you still receive $10,000. But if you bought a new property and now your rent is $20,000, your income doubled. And then when you pass away, the property passed to the seed, the principal passed to the charity. Now, you may ask, well, how about my children? So the children, if you wanted the children to still get the principal, with the part of the income, you buy a life insurance trust, and then when you pass away, you have a big chunk of money to your children. It's completely tax-free for them. There's no income tax, no estate tax for that. So that completes your story. Okay. You can combine the CRT with family trust, and you can also do a charity leader trust where you still keep the property. And this will be good for like a business. You want to pass on a family legacy. your family like the business, you keep it, you can do that. And then you can give the charity some income, and then also give some income to your family trust, for example. Okay. So tying together, you also want to create family limited partnerships and the trusts and foundations, and then you can, along with the charitable remainder trust, charitable leader trust, all of these that can plan your entire business and financial situations. Okay, so make sure you cross the I's and cross the T's, dot the I's and cross the T's, such as filing your 1065 and K1s, etc. Okay, so I think that's about it for your real estate strategies, and some of them also apply to your business as well. Okay, good, thank you.